AutoZone has had a whopping 5-year return of 182%, which dramatically outperformed the S&P 500 with a total return of 109%. And I think this trajectory of outperformance is destined to continue, especially considering AutoZone's relatively low trailing PE of 22.1 compared to the S&P's PE of 26.9. Today's video will be an in-depth analysis of AZO stock covering business operations, fundamental, and technical analysis. AutoZone is an auto parts retailer headquartered in the US, but they also have stores abroad. As of August 2024, they operate 127 stores in Brazil, 794 stores in Mexico, and their largest collection of stores is in the US at 6,432. So they're predominantly a US company, but their international stores look to be on the cusp of a growth boom, especially in Brazil with a 5-year store count compound annual growth rate of 24.2%. A 5.0% 5-year store count CAGR in Mexico, and their slowest store growth is in the US at just 1.8%, which is probably due to the fact that they've already saturated the domestic market. This international growth looks to be well-timed. Just as their US store growth is slowing, their international exposure is growing, which we can see through their international revenue growth rates, which have grown by double-digit rates each year for the past 4 years, while their domestic revenue growth has been substantially slower, and their most recent domestic revenue growth was only 0.4%. But revenue stability is still better than a decline. Despite their international segment growing quickly, their US revenue still makes up the vast majority of their total revenue, with 88% of their revenue coming from the US, 11% from Mexico, and 1% from Brazil. So we know where AutoZone generates revenue, but what do they sell? As their company name implies, they sell automotive parts, which are broken down further into various segments. The largest segment by revenue being failure, which encompasses parts that fail over time, like belts and hoses, clutches, and thermostats. Their next largest revenue segment is titled maintenance, which generally refers to parts and products required for periodic vehicle maintenance, like brake parts, filters, and oil. Their smallest segment by store revenue is discretionary, which refers to products in store that are non-essential to a vehicle, like floor mats and car wash soap. Outside of their stores, they also generate a minor portion of their revenue from a segment called Other, through a software system called AllData, which produces, sells, and maintains diagnostic, repair, collision, and shop management software used in the automotive repair industry and e-commerce. So it looks like they have 3 operating segments that are more or less essential, which makes up 86% of their revenue, while 14% of their revenue could be considered non-essential, which leads me to the macro-level pros of AutoZone's business. The most critical may be that they generally sell essential auto parts at 86% of revenue, which require replacement based on usage and time. I think any business that sells necessary parts is better suited in tough economic times, which we may be in currently or headed towards in the United States. Another advantage to AutoZone's business is that it's simple. Their business model is to retail auto parts through a store, which requires almost no innovation, as compared to another type of business like pharmaceuticals, for example, which demands that companies develop new products perpetually in order to continue growing their revenue, which requires significant research and development spending, which we can see through a company like Novo Nordisk, who spent $32 billion in 2023 on R&D in order to develop new medicines. AutoZone is on the other end of the spectrum, and their business requires little to no innovation in order to remain profitable, so long as car parts continue to wear and break. Another prominent benefit to AutoZone's business is that they are the most popular auto parts retailer in the US by number of stores, followed by O'Reilly and Napa, giving them the largest network to potentially acquire and maintain customers, which we can see through this graph of AutoZone store locations within a 10-mile radius, which basically represents every populous city in the US, and scale like theirs acts as a competitive moat. The last subtle benefit to their business is that they have a winning loyalty rewards program, which I've used personally and found great value in. The program gives customers $20 in rewards after they've spent $100 through 5 separate purchases, which is roughly a 20% store credit program, which will be used in the store again, leading to more revenue for AutoZone, and it also incentivizes people to have a minimum spend of $20 per purchase, and to continue buying auto parts exclusively at AutoZone. I think AutoZone is destined to continue growing, but there are some potential risks to consider. The greatest being the rise of e-commerce, and more specifically, Amazon. Amazon is the largest e-commerce retailer in the US by a massive margin, and it's become a one-stop shop for almost anything someone needs, which includes auto parts traditionally sold by AutoZone, which we can see by looking at the most searched items through AutoZone's website, all 10 of which can be purchased through Amazon, and sometimes at a lower or equivalent price. like we can see here with these Brembo brake pads, which have the same part number and are significantly cheaper through Amazon. AutoZone is aware of this competition, and that's probably why they have certain brands unique to AutoZone, like Duralast, or why you can't highlight and copy the parts from the main search page, at least starting from the end, although you can copy by starting from the beginning. Or maybe this is just some tech function that I know nothing about. Competition with Amazon and any other retailer is one of the reasons why companies create loyalty programs so that you continue to purchase through their company by incentivizing you to do so. Another long-term risk to AutoZone is that many of the items that AutoZone sells are for internal combustion engines, many of which aren't used in electric vehicles. And electric vehicles are growing in popularity, while internal combustion vehicles are decreasing in popularity. Although internal combustion vehicles still represent the vast majority of vehicles on the road, and the phase-out period will likely take decades due to older combustion vehicles remaining on the road. Now that we know the basics of AutoZone's business, we can look into how this translates into their financials. Their revenue over the past decade has grown every single year without fail, which gives credit to the essential nature of their business and has led to a compound annual growth rate of 6.1%. And better yet, this is on a non-per-share basis. And on the left, we can see that they're reducing their share count at an incredible rate, at a CAGR of 5.8%. So if you look at their revenue on a per-share basis, they have a substantially higher 10-year CAGR of 12.7%. This is the magic of share reduction and how it can lead to massive per-share growth rates, which is how stocks are generally valued, that is, on a per-share basis. Now we see their earnings per share, which are also growing at a phenomenal rate, at a 10-year CAGR of 15.0%. And just like revenue, their EPS has grown each year without a reduction. If we look at free cash flow per share, their growth rate is slightly less glamorous at a CAGR of 12.6%. And there's more volatility over the years, but the growth is still phenomenal. AutoZone's story becomes less rosy when we look at their current total liabilities level of $22 billion compared to cash and trailing 12 months net income, which is currently at 8.1 times, which is a fairly high liabilities level, and their liabilities have been growing substantially over the decade, starting from just $9.8 billion in 2015 to their current level of $22 billion. They also have almost no cash on hand, which indicates to me that management knows just how stable their business model is. So they're clearly valuing share repurchases over paying down debt, although accumulating debt seems to be a common tactic for companies these days. I typically cover dividend stocks on this channel, but AutoZone doesn't pay a dividend, and buying into AutoZone would purely be for capital appreciation. In terms of valuation, AutoZone is trading at a trailing 12 months PE of just 22.1, which is exceptionally low considering their revenue and EPS growth, which we can compare to O'Reilly Auto Parts, which has a nearly identical business model and growth rates, but they're trading at a PE of 31.1, which indicates serious undervaluation for AutoZone in my mind. Although when comparing AutoZone to its own 5-year average PE of 18.8, they're overvalued, being 17.8% above average. In summary of the fundamental analysis, I think AutoZone is poised to continue growing from the bottom up, beginning with their store count, primarily internationally and gradually in the US, as well as through their revenue and EPS. And on top of that, they're increasing shareholder value rapidly by reducing the shares outstanding. And better yet, they're trading at an objectively low PE ratio, considering their growth. But my one concern is their high total liabilities level. Here we see AZO over a 5-year time frame with a fantastic price return of 182%. And better still, they've done this with less volatility than the S&P 500, with a beta of just 0.72. In terms of the standard deviation channel, which shows the average price for this period, with this center yellow line, the current price is slightly above average, but only by 3%. Although, given AZO's lack of volatility, they rarely trade at a significant discount as they've basically just been going up over time. And given their strong fundamentals, I think they're likely to continue on this trajectory. So they're probably at a discount compared to where they'll be in 5 years. Since they've historically risen with such little volatility, I can't meaningfully draw any support and resistance lines either, except for the recent high at 3,256, which was a resistance level until it was recently broken. The most relevant support indicator that continues to show validity is probably the 90 EMA line graphed in blue. And based on this metric, they're overvalued by 12%. And personally, I intend to buy AZO when the price is near this EMA line again. Although, even if you were to buy AZO now and technically overpay, over 5 years you're likely to still participate in significant appreciation, assuming AZO continues on this trajectory. Using the relative strength index at the bottom of the chart looks to be another meaningful indicator for determining relative value. And almost every time the RSI was at this level around 45, price had some degree of reversal, and inversely, when the RSI was high or overbought around 65, there was a minor decline in price for a short period of time, like we see here in March or here in April and in February, and so on. On a personal note, AutoZone is one of my favorite stocks, and I used to trade AZO almost exclusively beginning in May of 2021, when I had more of a short-term mindset, which you can see here, but sadly, I don't own any shares currently. If you're looking for another stock that shows promise for the future, trading at a relative discount, check out this video covering Novo Nordisk. And if you've been waiting to purchase Seeking Alpha Premium at a significant discount, you can use my link below before the 30% discount expires on December 11th, although the code will still give you a discount, but it won't be as large after December 11th.
I'm not a financial advisor, and this is not financial advice. This is for educational and entertainment purposes.